There's a silent alarm ringing in the global financial system. It is a signal that most people can hear over the noise of daily headlines and stock market chatter. But the wealthiest institutions, the central banks, and the financial elite who survived 2008, they hear it loud and clear. It's the exact same alarm that sounded 16 years ago, right before the world economy was brought to its knees. And right now, it's not just ringing, it's screaming. The warning is coming from the one asset that never lies, gold. Its recent price movement isn't just a market trend, it's a distress signal, a flare sent up from the heart of the monetary system. And if you understand the pattern, you'll realize this isn't about getting rich. It's about what the smart money is desperately trying to protect itself from. To understand what's happening now, you have to look at the playbook from 2008. It wasn't just a random crash, it was a sequence of events, and gold's behavior was the key. In early 2008, as the first cracks in the subprime mortgage market started to show, gold did something unprecedented. It surged past $1,000 an ounce for the very first time. To the public, it was a celebratory milestone. But to the insiders, it was a warning. It was the smart money quietly heading for the exits, while everyone else was still dancing. But then, as the crisis hit its peak and Lehman Brothers collapsed, something strange happened. Gold prices fell sharply. Amateurs panicked, thinking gold had failed as a safe haven. They were wrong. They didn't understand they were witnessing the playbook's second step, the great fake-out. In a true liquidity crisis, everything gets sold, even the good assets, because institutions need cash to cover their losses. This was the final deceptive dip, the last chance to get in before the real move, because what happened next exposed the entire game. The Federal Reserve turned on the money printers, slashing interest rates to zero and flooding the system with trillions in newly created currency. And from its low point, gold didn't just recover. It launched into one of the most explosive rallies in history, more than doubling in price. The lesson was crystal clear. Gold's initial surge is the warning, the dip is the opportunity, and the rally that follows is the inevitable result of the government's response to the crisis. Now, fast forward to today. The first part of that playbook is repeating with terrifying precision, only on a much grander scale. Gold has been shattering records, blowing past resistance levels that held for years, and surging to all-time highs well above $2,400 an ounce. This isn't a slow, steady climb. It's an aggressive, deliberate move that signals a profound loss of faith in the conventional financial system. The mainstream media will try to explain this away with talk of inflation or geopolitical tensions. But those are just symptoms. The real cause is far more alarming. This record-breaking price action is the warning shot. It's the world's financial insiders starting their exit, just like they did in 2008. They've seen the cracks forming, they've read the first page of the playbook, and they are moving their wealth into the one asset that can be printed into oblivion or defaulted on. But the most shocking part isn't just that the price is rising. It's who is behind this unprecedented buying spree and why they are doing it with such urgency. The real story is happening behind the scenes, in the vaults of the world's most powerful institutions. The biggest buyers of gold right now aren't individual investors, they are central banks. For the last 2 years, central banks have been buying gold at a pace not seen in over 50 years. This isn't just portfolio diversification. This is a strategic, coordinated exodus from the US dollar. China is leading the charge, with its central bank buying gold for 18 consecutive months, relentlessly stacking physical bullion while simultaneously selling off its holdings of US treasuries. But they're not alone. Poland has repatriated its gold from overseas and is aggressively adding to its reserves. Turkey, Singapore, India. Dozens of countries are quietly following the same script. They all learned a critical lesson in 2022 when Russia, $300 billion in foreign reserves were frozen with a single keystroke. In that moment, the world realized that dollar-denominated assets are not true ownership. They are a promise from a government that can be broken at any time. Gold, however, has no counterparty risk. It's an anonymous physical asset that sits in a vault and answers to no politician. This global gold heist is the ultimate vote of no confidence in the dollar-based system. These countries aren't just hedging against inflation, they're preparing for a world where the dollar is no longer the undisputed king. And what they're escaping from is even more terrifying than the alternative. While all eyes are on gold's historic rise, the foundation of the economy is actively crumbling beneath our feet. The warning signs are no longer theoretical. They are here. In March of 2023, we got a terrifying preview when Silicon Valley Bank and Signature Bank collapsed almost overnight. It was the second and third largest bank failure in US history. And it happened with breathtaking speed. Regulators tried to calm the public, calling them isolated incidents. But they were tremors, signaling a much larger earthquake to come. These banks failed because they were crushed under the weight of the Federal Reserve's aggressive interest rate hikes. And they are not the only ones feeling the pressure. Hundreds of other regional banks are sitting on massive unrealized losses in their bond portfolios, a direct consequence of the Fed's fight against inflation. At the same time, one of the most reliable recession indicators in history has already sounded its alarm. The yield curve, which has predicted nearly every recession for the last 60 years, was inverted for an extended period, but the real danger signal is that it has recently started to uninvert. Historically, the recession doesn't begin during the inversion. It begins 6 to 12 months. After, the curve returns to normal. That process has already started. The countdown has begun, and the banking tremors of last year were just the opening act for a much bigger crisis waiting in the wings. The real danger, the one that keeps central bankers awake at night, isn't hiding in the bond market. It's hiding in plain sight, in the half-empty office towers that define our city skylines. The commercial real estate market is a ticking time bomb, and it's primed to be the subprime mortgage crisis of this generation. The logic is brutally simple. The rise of remote work has left office buildings across the country with record high vacancy rates. With fewer tenants, the income these properties generate has collapsed. Now here's the problem. Over the next 2 years, trillions of dollars in commercial real estate loans need to be refinanced. These loans were taken out when interest rates were near zero. Today, they have to be refinanced at rates that are 4 or 5 times higher. With collapsed income and soaring borrowing costs, it is mathematically impossible for many property owners to make their payments. Mass defaults are not a possibility. They are an inevitability. And who holds all this toxic debt? It is not the big Wall Street banks who learned their lesson in 2008. It's the smaller regional banks, the same ones that are already weakened and vulnerable. This is a doom loop waiting to happen. And when it detonates, it could trigger a wave of bank failures that would make 2023 look like a minor hiccup. This places the Federal Reserve in the most difficult position it has faced in modern history. They are caught in an impossible trap with no good options left. On one hand, inflation remains stubbornly high, forcing them to keep interest rates elevated. But every day they keep rates high. They are tightening the screws on the commercial real estate market and the regional banks, pushing the entire system closer to the breaking point. If they hold their nerve to fight inflation, they risk triggering a catastrophic wave of defaults and a deep, painful recession. On the other hand, they could do what they always do: panic and cut interest rates to bail out the banks and the real estate market. But doing so would be like throwing gasoline on the inflationary fire, signaling to the world that they have given up on defending the value of the dollar. This would trigger another surge in the cost of living, crushing ordinary people and accelerating the global exodus away from the dollar. Either choice leads to disaster: a crash caused by high rates or a collapse in purchasing power caused by money printing. The smart money, from central banks to wealthy families, sees this impossible choice, and they know the ultimate outcome is the same. The value of paper money is in jeopardy, and they are trading it for the only real money that has survived every financial crisis in history. What makes this situation so much more dangerous than 2008 is that the entire system is running on fumes. The solutions used to fix the last crisis have become the poisons of today. In 2008, the US national debt was around $10 trillion. Today, it has exploded to over $34 trillion and is growing by $1 trillion every 100 days. The Federal Reserve's balance sheet, which was under $1 trillion before the 2008 crisis, ballooned to nearly $9 trillion as they printed money to prop up the system. They never managed to shrink it back down. Corporate debt has also soared to unprecedented levels, as companies took advantage of years of cheap money to load up their balance sheets. The entire global economy is more leveraged, more interconnected, and more fragile than it has ever been. We solved the debt crisis by creating an even bigger mountain of debt. The financial life support that was put in place 16 years ago was never removed. Now the patient is weaker than ever, and the medicine has stopped working. This is why gold's move is so significant. It's not reacting to market sentiment. It is reacting to the mathematical certainty that a system this leveraged cannot survive. It is pricing in the inevitable conclusion that when this crisis hits, the only possible response will be a flood of money printing that will dwarf anything we have ever seen before. The signals are all converging. The 2008 playbook is repeating step by step. We have the initial warning shot from gold, which has surged to all-time highs. We have the world's central banks engaged in a historic escape from the dollar system, trading paper for physical bullion. We have the banking system already showing deep fractures, with the tremors of 2023 set to return as the commercial real estate time bomb gets ready to detonate.